October 28, 2008. The opening bell rang at the Frankfurt Stock Exchange. For traders, it was supposed to be another difficult day in the middle of the worst financial crisis in generations. Banks were collapsing. Markets were in freefall. Every headline seemed darker than the last. But within minutes, something appeared on the trading screens that made even veteran investors question what they were seeing. Volkswagen shares weren't falling. They were exploding. 200 euros, 300, 500, 800, then even higher. Every refresh of the screen showed another impossible number. And before the trading day was over, Volkswagen had briefly become the most valuable publicly traded company on Earth. Not because it had invented a revolutionary new car, not because it had announced record profits, and certainly not because the global economy was booming. In fact, the exact opposite was happening. The world was falling apart, yet somehow a German car manufacturer had overtaken corporate giants like ExxonMobil, temporarily surpassing every publicly traded company in the world by market value. For one extraordinary day, financial reality seemed to stop making sense. How could that happen? How could an ordinary automaker suddenly become the most valuable company on the planet while the global economy was collapsing around it? The answer wasn't hidden inside an engine. It wasn't found on a factory floor. It wasn't even about selling cars. It was hidden inside one of the most sophisticated financial strategies ever attempted in the automotive industry. A strategy so ambitious that it trapped some of the world's largest hedge funds. A strategy that would eventually trap its own creator. Because this isn't just the story of Volkswagen, it's the story of Porsche, a company that tried to take control of an empire and nearly destroyed itself in the process. To understand how one of the strangest events in financial history became possible, we need to go back 6 years. At the beginning of the 2000s, Porsche appeared to be in an enviable position. Its cars were admired around the world. Its profit margins were among the highest in the automotive industry. Models like the 911 had become icons, while the Cayenne had proven that Porsche could expand beyond traditional sports cars without losing its identity. By almost every financial metric, Porsche was thriving, but success wasn't enough. Its executives understood something that many investors overlooked. Porsche was still a relatively small company operating in an industry increasingly dominated by global giants. Companies weren't simply competing with better cars anymore. They were competing with scale. Bigger manufacturing networks, bigger supply chains, bigger research budgets, and greater bargaining power. No matter how profitable Porsche became, it would always face competitors many times its size. Its leadership believed that long-term influence would require something much bigger than selling sports cars. They needed strategic control, and there was only one company capable of giving them that: Volkswagen. At first glance, the idea sounded almost ridiculous. Porsche was the smaller company. Volkswagen was a manufacturing giant employing hundreds of thousands of people. Its factories stretched across Europe. Its influence reached nearly every corner of the automotive market. This wasn't just a company, it was an industrial ecosystem. Under the Volkswagen umbrella were brands like Audi, Skoda, Seat, Bentley, Lamborghini, and several commercial vehicle businesses. Controlling Volkswagen wouldn't simply make Porsche larger, it would place Porsche at the center of one of the largest automotive groups on Earth. Most executives would have considered such an acquisition impossible. Porsche's CEO, Wendelin Wiedeking, didn't. He believed size alone didn't determine who controlled a company. Ownership did, and ownership could be engineered, but not through a traditional takeover. If Porsche openly announced that it wanted to buy Volkswagen, the market would react immediately. The share price would soar. Politicians would become involved, competitors would pay attention, and the opportunity could disappear overnight. So Porsche chose a very different path, one that almost nobody fully understood. Instead of making headlines, it began quietly building a position behind the scenes, patiently, carefully, almost invisibly. What looked like ordinary financial transactions was actually the beginning of one of the boldest corporate takeover attempts in modern history, and almost nobody saw it coming. Porsche wasn't secretly buying millions of Volkswagen shares in the traditional sense. That would have been far too obvious. Instead, it turned to a corner of the financial world that most people never think about: derivatives. financial contracts that could provide economic exposure to a company's stock without immediately appearing as direct ownership. To most investors, these transactions looked like routine hedging. Large corporations used derivatives all the time to manage financial risk. Nothing seemed unusual, but Porsche wasn't simply protecting itself from market fluctuations, it was quietly building influence. Every new contract gave the company greater control over Volkswagen's shares while allowing much of that exposure to remain hidden from the broader market. From the outside, Volkswagen still looked like a normal publicly traded company. Behind the scenes, however, more and more of its available shares were slowly disappearing, and almost nobody realized it. Year after year, Porsche continued increasing its position. The market noticed occasional disclosures, but very few people understood the true scale of what was happening. Most analysts assumed Porsche was simply protecting an existing investment. Few imagined it was preparing one of the boldest takeover attempts Europe had ever seen. By 2007, Porsche revealed that it had accumulated a significant stake in Volkswagen. The announcement surprised investors. Volkswagen's share price moved higher. Financial newspapers covered the story, but even then the full picture remained hidden. Many believed Porsche had already shown all of its cards. In reality, it hadn't even revealed its strongest hand. While Porsche continued expanding its position, another story was unfolding across the global economy. One that would convince thousands of professional investors to make exactly the wrong decision. In 2008, the financial system was beginning to crack. Banks struggled under the weight of toxic mortgage securities. Credit markets froze. Confidence evaporated. Then came the collapse of Lehman Brothers. One of the largest investment banks in the United States disappeared almost overnight. The shock spread through global markets like an earthquake. Companies stopped investing. Consumers stopped spending. Factories slowed production. Entire industries suddenly looked vulnerable. The automotive sector was hit especially hard. Demand for new vehicles began to weaken. Manufacturers faced falling sales, shrinking profits, and growing uncertainty. To hedge funds around the world, the trade seemed almost too obvious. If the global economy was entering recession, car companies would surely suffer, and if car companies suffered, their stock prices should fall. Volkswagen looked like one of the safest bearish bets available. Inside hedge funds from New York to London, portfolio managers reached remarkably similar conclusions. Volkswagen was a giant industrial company. Its valuation looked expensive. The economy was deteriorating. The mathematics appeared simple: borrow the shares, sell them immediately, buy them back later at a lower price, keep the difference. It was a strategy known as short selling. On paper, it made perfect sense. And because so many experienced investors reached the same conclusion, confidence became something even more dangerous. Consensus. The more people agreed, the less anyone questioned the trade. Risk models approved it. Investment committees approved it. Analysts published reports supporting it. The market seemed to be speaking with one voice. Volkswagen was expected to fall, but there was one variable almost everyone underestimated. Not Volkswagen's earnings, not vehicle sales, not the global economy. Ownership. Because Volkswagen wasn't like most publicly traded companies. A large block of shares was permanently held by the German state of Lower Saxony. Those shares were never expected to enter the market. Long-term strategic investors controlled another significant portion. That already left a surprisingly small number of shares available for everyday trading. Known on Wall Street as the free float. To most investors, that detail didn't seem important, would soon become the only thing that mattered. As hedge funds continued building larger and larger short positions, Porsche continued quietly tightening its grip. One side believed there would always be enough shares available to buy. The other side knew that assumption was dangerously fragile. Neither group fully understood what would happen when those two strategies finally collided, because the trap wasn't designed to close all at once. It was designed to close the moment everyone realized there was no way out, and that moment was now only days away. Then, on Sunday, October 26, 2008, Porsche made an announcement. At first glance, it looked like another routine corporate statement. It wasn't. Buried inside that announcement was a number that changed everything. Porsche revealed that it directly owned more than 42% of Volkswagen's shares. But that wasn't the real surprise. Through cash-settled options and other derivative contracts, it effectively controlled another 32%. Together, Porsche had influence over roughly 74% of Volkswagen. Suddenly, investors around the world began doing the math. Lower Saxony still owned about 20%. Those shares weren't for sale. Porsche effectively controlled another 74%. That left barely 6% of Volkswagen's shares available for trading, just 6%. And yet, hedge funds had collectively sold short far more shares than that. For months, they had been borrowing and selling Volkswagen stock, fully expecting to buy it back later at lower prices. Now they all reached the same horrifying realization. There simply weren't enough shares left to buy. The trade that had looked perfectly rational only days earlier had become mathematically impossible. By the time markets opened the following morning, panic spread across trading desks around the world. Phones rang non-stop. Orders flooded into exchanges. Risk managers demanded immediate action. Portfolio managers who had spent months defending their positions suddenly wanted out at any cost. But there was one problem. Everyone wanted to buy. Almost nobody wanted to sell. The trap had finally closed. To understand what happened next, you have to understand one simple rule of short selling. When you short a stock, you can wait. You can hope. You can even ignore temporary losses. But eventually, you must buy the shares back. There is no alternative. That single rule transformed thousands of confident investors into desperate buyers. And desperation is one of the most expensive emotions in financial markets. As the first buy orders hit the market, Volkswagen's share price jumped sharply. Then another wave arrived, then another. Each increase forced even more short sellers to cover their positions. Those purchases pushed the price even higher, which forced even more investors to buy. It became a self-feeding chain reaction, a financial avalanche that grew larger with every second. Within hours, price discovery had completely broken down. Volkswagen shares were no longer rising because investors believed the company was worth more. They were rising because fear had replaced logic. Liquidity disappeared, supply vanished, demand became infinite. Every available share suddenly became priceless. Traders weren't negotiating anymore. They were competing for survival. Some hedge funds tried to delay, others accepted enormous losses, many had no choice at all. If they couldn't buy the shares voluntarily, their brokers would buy them automatically. At whatever price the market demanded, billions of euros were erased in what felt like the blink of an eye. Experienced traders later described those hours as some of the most chaotic they had ever witnessed. Every new price seemed impossible, only to be replaced by an even higher one minutes later. And then the unimaginable happened. For one brief moment, Volkswagen became the most valuable publicly traded company in the world. A company that, only days earlier, had been viewed as another struggling European automaker during a global financial crisis, was suddenly worth more than the biggest corporations on the planet. It wasn't the result of revolutionary technology. It wasn't record-breaking sales. It wasn't a miracle. It was a market structure collapsing under its own weight. For one extraordinary day, Volkswagen stood above every other publicly traded company on Earth. Not because its factories had changed, not because it had suddenly become more profitable, but because a hidden ownership structure had collided with billions of euros in short positions. It was, in many ways, a financial illusion, one created not by fundamentals, but by leverage, scarcity, and panic. Ironically, what looked like Porsche's greatest victory would soon become the beginning of its biggest crisis, because creating the world's most valuable company for a single day came with a price that Porsche itself was about to pay. At first, Porsche looked like the winner. The company had done what almost everyone believed was impossible. It had cornered the market. It had triggered one of the most dramatic short squeezes in financial history. And for a brief moment, it appeared to control the destiny of Europe's largest automaker. But financial markets have a way of punishing even the most brilliant strategies, especially when those strategies rely on enormous amounts of borrowed money. Behind the headlines celebrating Porsche's success, another story was quietly unfolding. Building such a massive position in Volkswagen hadn't been cheap. Many of Porsche's derivative positions were supported by debt. As long as markets remained stable, that debt looked manageable. But after the short squeeze, stability disappeared. The financial crisis was spreading across the world. Banks were becoming increasingly cautious. Credit markets tightened. Lenders who had once been eager to finance ambitious deals suddenly wanted to reduce risk instead. Porsche found itself under growing pressure, not because its cars had stopped selling, not because its engineering had failed, but because the financial structure supporting its takeover had become dangerously expensive to maintain. Every new round of financing became more difficult. Every negotiation with lenders became more complicated. Every passing week increased the pressure. For years, Porsche had been the hunter. Now it was slowly becoming the hunted. The irony couldn't have been greater. The company that had exposed the weakness of the market was now discovering the weakness of its own balance sheet. Control on paper didn't automatically mean financial strength. Eventually, reality caught up. Porsche needed help. The takeover it had spent years carefully planning was becoming impossible to complete. Instead of absorbing Volkswagen, Porsche now needed Volkswagen's stability. Negotiations changed completely. The balance of power shifted. And what had once been discussed as Porsche acquiring Volkswagen gradually evolved into the opposite. In 2009, both companies agreed to pursue an integrated future rather than continue a costly corporate battle. Over the following years, that plan became reality. By 2012, Volkswagen had fully integrated Porsche's automotive business into the Volkswagen Group. History had taken a remarkable turn. The smaller company that tried to control the giant had ultimately become part of it. And yet, this wasn't really a story about winners and losers. Porsche didn't disappear. Its sports cars continued to define performance engineering. Its brand became even stronger under the Volkswagen Group. Today, Porsche remains one of the most profitable and prestigious automotive brands in the world. Volkswagen also survived one of the most extraordinary episodes in financial history. In many ways, both companies continued to succeed, but the battle between them permanently changed the way investors think about ownership, liquidity, and market risk. Business schools still teach the Volkswagen short squeeze. Risk managers still study it. Traders still talk about it, not because of how much money was made, but because of how quickly perfectly rational assumptions collapsed. The hedge funds weren't foolish. Porsche wasn't reckless. Each side believed its strategy was supported by logic. Each side trusted the numbers, but markets are governed by more than spreadsheets. Sometimes the structure of ownership matters more than the value of the business itself. Sometimes liquidity matters more than profit, and sometimes the biggest risk is the one almost nobody is looking at. That's what made the Volkswagen short squeeze so unforgettable. It wasn't simply a spectacular rise in a stock price. It was a reminder that markets are driven by human behavior as much as mathematics. Confidence can become overconfidence. Logic can become consensus. And consensus can become the most dangerous place an investor can stand. Porsche set out to reshape the automotive industry. Instead, it reshaped financial history. Because in the end, the most valuable lesson wasn't about building faster cars or bigger companies. It was about understanding the invisible forces that hold markets together. The forces most people never notice until they suddenly break. And perhaps that's the greatest irony of all. Porsche came within reach of controlling an empire, but in trying to master the system, it discovered that no one truly controls the market, only the rules. And for one extraordinary day in October 2008, the entire world was reminded just how powerful those rules can be.